Hi folks, and welcome to this short lecture on convertible debt, where debt is converted at the investor's option. First of all, just a few words about what convertible debt is. First of all, it allows investors to convert part of their debt into equity. And so in other words, what will happen is that you might buy a bond and as an investor, and that bond offers you the privilege of converting at your option any part of that bond into common shares. So it's usually the case that investors will pay a premium because they have the option to stay with the debt and get the steady stream interest payment, and or at their option they can convert into shares. But first of all, just a few notes. When conversion is at the investor's option, the market price of the shares needs to exceed the conversion price in order to motivate them to convert, obviously. Otherwise, why would they convert? So just to give you an example of what we mean here, say for example an investor has a $1,000 bond, and each $1,000 bond is convertible into 10 common shares. Then the conversion price is really $100 a share, right? We take the value of the bond that they bought, which is a $1,000 bond, and if it's convertible into 10 common shares, then it really says that the conversion price is $100 a share. So the shares would really have to be worth more than $100 in order to motivate the investor to convert. But we as the issuer, we'd probably be very happy if they convert, because less cash flow out the door. In other words, you wouldn't have to pay interest on the bond. You wouldn't have to pay the lump sum cash payment at the end if the investors actually converted. So the issuer of the bond never knows whether or not the bond will ever convert, either in whole or in part, because it is the case that if the share price doesn't reach the conversion price, then the bond in all likelihood is going to be paid out in cash at maturity. That's how you retire it, and again, along the way you'd be making your steady stream interest payments. So now, will conversion in fact happen? Well, how do we know at the issue date if the bond will be converted? Well, the fact is we don't know, because we don't know what's going to happen to the market price of the shares. So the outcome of a conversion, i.e. whether you'll convert or not, is really not certain. So therefore, is the bond, do we consider it to be purely debt? Do we consider it to be equity, or do we consider it to be both? And in fact, we consider it to be both. So one of the challenges we have as an accountant is to determine how we are going to value the debt piece of the convertible bond and the equity piece. So we normally call these convertible securities hybrid securities or complex financial instruments when the convertible debt has a liability piece, which is the bond, and the equity piece, which would be the conversion rights. So we would record both the value of the debt, which is the bond, and the equity portion, which is called conversion rights, and those conversion rights are in fact a contributed capital accounts. They're in the shareholders' equity section. So they're usually part of other contributed capital. So you've got in contributed capital, you have two types, right? You have your share capital, which is your preferred and your common shares, and then you'd have your other contributed capital, and the conversion rights would be part of that other contributed capital. So how do we value both the debt and the equity piece? Well, the first thing we do is we use a method known as the incremental method, and under the incremental method, what we do is we say we will value the bonds first, and then we will squeeze out the equity portion. So that's how come it's called the incremental method. So the equity piece is really valued as an increment, as the difference between the cash that you got for the instrument when you issued it and the carrying value of the bond. So the conversion rights, as we said before, are really part of contributed capital when the convertible debt is issued. When the convertible debt, or when the convertible debt is actually converted, so when those rights are exercised, then your conversion rights really get folded in to the common share account, because you're going to debit or reduce those conversion rights and issue the shares. And again, if the rights expire, so in other words, if we get to the end of the term of the bond and there was no conversion that actually took place, and the bond is just paid out in cash, then the conversion rights, which are part of contributed capital, were never exercised, so we reclassify the conversion rights as expired or lapsed rights, and it's still part of your contributed capital. So that's a little bit of theory, and probably to make it a little more real for you, we can go through a question. So let's have a look at this question where we have a company that issues 800,000 6% 3-year bonds, and that's for 806, and the bonds will pay interest annually at the end of the year. Again, we can see it's convertible at the investor's option because it can be converted into 60,000 common shares at the investor's option or repaid in cash if that's what the investor wants. And the market rate for bonds of a similar term and risk but that are not convertible is in the range of 7%. So again, that market rate of 7% is going to help us calculate the portion of the bond that we're going to record as a liability. Remember, we said that under the incremental piece, that's usually the first thing we do. So the first requirement in the question will have us calculate that portion of the liability. So using your calculator, make sure you set your P/Y to 1, and we're going to set our future value up at 800,000, and again plus or minus to make it a negative because it's going to be an outflow. 48,000 is your cash payment every year. That's your 800,000 times your coupon or your stated rate. Your interest rate per year, again, it's a 3-year bond and interest is paid annually, so the number of interest payments is going to be 3. So when we hit compute PV, we're going to get $779,005, and we can see the bond trades at a discount. So therefore, when the entry is made as Nero's going to make an entry on its books to accept the cash of 806 to record a bond liability at 800,000, but this again is the present value of the bond, right? So we know that the discount, if we wanted to calculate the discount at the time that we bought the bond or we issued the bond, it would be 800,000 less 779,005, and that would give us the amount of our actual discount, which is 20,995. So again, that number in here, that's the amount of your discount. We would set that up, and then again we would set up by squeezing out the value of the common share conversion rights, which is 26,995. So those rights, again, the value are squeezed out. Okay, and that's again following the incremental method. So now, again, since the bonds aren't converted, we as Nero are going to continue to pay interest. So what would the interest expense be over the life of the bond? Well, I just decided to do a table to show you what that would be annually for the bond and how we would book that interest expense, because the issuer, Nero, is going to have to make journal entries to record the discount that's being amortized, book the expense, and make the interest payment. And that's one of the requirements of the question, as you'll see later on. So all I did is set up a typical amortization table. I'm sure you've seen many of these before. And again, to get the interest expense, we're going to multiply the book value to open up the 1-year period that is now ending, and multiply that by the market rate for the year, which is 7%, and we're going to get 54,530. The difference between that and the interest paid is going to be the amount of the discount amortized, therefore leaving us with unamortized discount on the balance sheet of 14,465 and a carrying value of the bonds which is equal to 800,000 less 14,465, which will give you 785,535. And we're going to take that amount, again, that's the carrying value to open up the second period, multiplied by 75% to 7%, sorry, in order to calculate our interest expense for the period. Moving on, we'll see that we can now use our table to make our journal entries for interest by amortizing the discount, paying out the cash, and booking the interest expense. So we would be looking here in these three columns every year in order to make our journal entries for interest expense. Now, moving on to the next requirement, let's record the maturity of the bond, assuming that the shares were issued. So let's assume that at the end of the period, instead of taking the cash payment, the investors decided they've scooped up their interest payments. Now they've decided that at the end they would convert. to common shares. So now what would happen? Well, don't forget, when we set this bond up, we had conversion rights that have never been exercised yet, right? So now at the end of the period when they're being exercised, what we're going to do is we're going to debit that account, just on the wrong side of the ledger there. We're going to debit the conversion rights account because we're going to remove them from the books, remove the bonds, and then issue the common shares at what we would call their book value. So this method is called the book value method when you're actually recording the share issue. So you'll notice that when you're recording the conversion rights at the issue date, when you're issuing the bond, we calculate the value of those conversion rights using what we call the incremental method. Now, if there is an actual conversion and we're issuing the shares, we use what's called the book value method to issue the shares. And notice that those shares aren't being recorded at their market value. Now, if the market value is more, okay, at the time that they convert, then the shareholders can do what they want. They can take their shares and sell them for cash in the open market. Up to them. Right? Now, let's assume instead of recording the bond at maturity assuming shares were issued, what if the shares weren't issued? Maybe the market price never exceeded the conversion price, so cash is paid out at the end. So what we're going to do is we're going to remove the bond from the books, okay, pay out our cash. And don't forget, we had these common share conversion rights here, part of our contributed capital that we recorded at issue date, which were never exercised. So what we're going to do now is we're going to go down here and remove them from the books. But don't forget, part of the amount that these investors paid, part of the premium they paid, was to get these conversion rights. It just so happened that they never had the opportunity to exercise them. So they've paid for these rights. So when we take them off the books, because we still got money for them, we keep them on the books as contributed capital, but we just reclassify them as lapsed or expired rights. Okay, so they're still on the books. There's still a section in the contributed capital for them, and it's called lapsed conversion rights, and it's still part of your contributed capital. Okay, so now let's move on to the next requirement in this question. Let's say that the bond was repaid after year 2 before it matured. So in other words, maybe the issuers of the bond decided that they wanted to take it off the market now because exercise was at the investor's option. Maybe what they had to do was give them some kind of a sweetener or an inducement to retire the bond at an earlier date. So you can see here that they did pay a little bit more than the face value. In fact, more than the investors initially gave them. They're paying $810,000 to the investors at the end of year 2, and $8,000 of that amount was allocated to the conversion rights. So the idea here is that because the issuer now has decided that they want to retire the bonds, and they might do that because maybe they might look at it and say, hey, we're paying 6% a year to these guys. Could be that the rates have come down, and they've decided that, maybe we can be paying less interest. So maybe if the price is right, we'll get these guys to take the cash payment, and then we'll reissue debt with lower terms, right? Lower interest rates, and save some money. And maybe they'll issue the debt for a longer period of time. We don't know what they'll do. But the idea is that certainly investors can do that, but investors don't go away lightly if it's at their option. In this case, we're going to assume they took the deal. They accepted the $810,000. So here what you want to do is you want to calculate the amount of the unamortized discount. Now, we did do the table earlier, so we know that at the end of year 2, if we just scroll back up here, at the end of year 2, we have unamortized discount of $74.78. So what we would do is we would remove that from our records, right, as well as the bond. So I've just color-coded it here to show that if that's the first step, this is the way I do it, by the way. Other people do things in different orders. This is the way I process it. I'm going to get rid of the bond and rid of the applicable discount by fully amortizing it. Now, step 2, I would say, since the conversion rights are not going to be converted because we're taking the bonds off the market, I'm going to remove that whole account. So I'm going to debit color coding here. So step is purple, in the entry it's purple, so I'm getting rid of those conversion rights at $26,995, which was the value at which I set them up. Okay, now again, part of this step is also to record the contributed capital on what we call retired conversion rights, to remove the rights at their true value based on the cash price paid. So in other words, what I'm saying is that we want to make sure that those rights, we know that when we gave our $810,000 out, that part of that $810,000 represented $8,000 in rights. Well, right now we've got those rights on our books at $26,995. So when we remove them, we want to reflect the fact that they're really only worth $8,000, not $26,995. So we take them off. If you net out from this original contributed capital in the conversion rights account the retirement, okay, of those conversion options, at net you're getting rid of $8,000 in conversion rights, which is what they're valued at, because that was part of the $810,000 that Nero gave its investors. So now you have this contributed capital in the retirement of the conversion options, which is $18,995, and again that's a plug figure, and we calculate it by taking the value that we have the conversion rights on our books at now less what the rights are really worth. So the difference between the two is the the retirement of the conversion option, which is part of your contributed capital. And again, notice that the difference really takes the conversion rights off your books at net at $8,000, which is their current value. In step 3, we're going to record the cash that's paid for the convertible bond. So therefore, the last step is to plug a gain or loss on the bond repayment. So that handles requirement 6. All right, which is retiring the bond, okay, before maturity and paying investors a premium in order to do so. Now, let's look at the last requirement here. Let's say that instead of requirement 6, let's say that we're not paying it out early, but what's happening is that, say, investors decided to exercise their option and convert not all, but some of the bond holdings into common shares at the beginning of year 3 or at the end of year 2 after the interest was paid. So first thing we'd want to do is we'd want to take those bonds off the books, but don't forget they're not matured, so what we need to do is we need to make sure, and we're not taking them all off the books, right? So we want to calculate the present value of the bonds that we're removing. So how much are we removing? Well, we're removing 1/4, 25% of the $800,000, which is $200,000. So I'm going to calculate the present value of those $200,000 in bonds by using my calculator here. So $200,000 plus minus the future value. So that's the cash outflow. My interest payment that I would be making is $48,000 times 25%, because the $48,000 was the full amount of the payment for $8,000 in bond, or $800,000 in bonds, but I'm only making a payment on 25%. Now don't forget, I have only one period left to go because I'm doing it at the beginning of year 3. It's only a 3-year bond, so instead of plugging in n equals 3, I plug in n equals 1 because that's the length of time we have to go to maturity. And again, I know my interest rate is 7 for the year, so when I press compute PV, I know that the present value of those $200,000 in bonds that are being retired is $198,131. So the remaining or unamortized discount is $1,869. So now what's going to happen is I'm going to have to remove that $1,869 from my books along with the $200,000 in bonds, and I'm also going to have to calculate the amount of the contributed capital that's on the conversion rights that's coming off the books as well. Well, don't forget, if I call that step 2, I know that the conversion rights when I booked them were at $26,995. Well, I'm getting rid of 25% of the bonds, which means I'm converting 25% of those bonds, but I'm also using the rights to do it. So 25% of the value of the rights comes off the books at $67.49. Now what I have to do is I need to credit the common shares that I'm going to issue on my book. So I have to give that amount of value. So now if we use the book value method here, because don't forget, we're not issuing them at market, we're issuing them based on the value that the investor gave us for the rights. So using the book value method, we're going to calculate the value of the common shares as the residual, the difference between, or the carrying value of the bonds plus the value of the options that we are using up. So we're using up $6,749 in the options or the conversion rights and $198,131. We're using that up, or that's our carrying value of the bond. So now we're going to get the value of the common shares to equal $204,880. So therefore, we would credit the common shares for that amount, all right, in step 3. So now, you'll also see here that we've removed the bonds at their face value and also removed the unamortized discount because we're not going to be amortizing 25% of that bond anymore. They're coming off the books. We're getting rid of the conversion rights that apply to that 25% of the bond, which is applying to $200,000. That's your $67.49. And again, credit our common shares for their book value, which is $204,880. So this concludes our video on convertible debt being converted, issued and converted at the investor's option.